Okay, so very good morning and welcome to the briefing then for Tuesday the 26th of July. Hope you all had a good evening. I think probably most appropriate then to start with just a brief recap of some of the price action we saw yesterday. So just sharing with you a couple of charts here, and probably most prudent to start with crude oil, because that was really, I felt, was one of the main drivers of the downward move that we saw at the open of Wall Street yesterday in the equity markets, albeit we did manage to recover by the close. But crude, you can see here, I've got it on a slightly longer dated chart. So looking at the last 5 days or so, and we've been on a continued downward trend. But if I just show you the area of yesterday where we were trading in CLE, this kind of fall more recently. Now, a couple of things of note that have been ongoing in oil, as I think Bill was talking about in the briefing yesterday, quite quietly and very much in the background, crude oil has seen a fairly sizable correction of sorts from around closer to the $50 handle to now trading a 43 handle. If you think back to last Friday, we had the rig count in North America, and operational rig counts have been moving higher. And this, of course, comes in combination with the fact that the Department of Energy's weekly inventories we had last week continues to show US output is on the incline. I think the last 2 weeks it's been up 0.6% and 0.1%. So US output's been rising, rigs have been coming back online to some respect. In addition, we had the first of the actual inventory data from Genscape with the Cushing figure, 1.14 million build. That's fairly sizable for that piece of data. So that's another downward force to prices yesterday. And then some of the latest CFTC, the Commodity Futures Exchange, looking at the speculative futures contracts in the market, showing that spec traders, hedge funds have got some of the highest amount of shorts in crude oil in the market for some time. So there's certainly a couple of downward themes ongoing for oil specifically. Then if you look at a broader global demand macro perspective, you've obviously got fears of a slowing world economy. The fact that Brexit have knock-on effect to Europe and so on and so forth. So, there's a number of things here at play with crude oil, and given yesterday's calendar was particularly quiet, it did prompt a fairly robust sell-off at the open on Wall Street yesterday, and I think a large portion of that is given the fact that with US equities, that was the sell-off at the open, we kind of moved through that initial support found at pivot, a break of that once the liquidity and volume picked up at the open at around 2:30, 3 o'clock yesterday. And then it just tracked oil with a lack of any other real drivers on the calendar. The other thing as well, though, to keep in mind is in terms of the US equity market yesterday, that was the Asia Pac high. That, of course, again, is all-time highs for US equities. Given the number of risk events upcoming this week in the form of bank earnings, central bank announcements, important US data predominantly on Friday, European stress tests, may be an opportune time to just book some profits with the S&P having printed at 72.5 yesterday. So that was the kind of story then. Moving on to now, looking on the top right, want to share with you the Japanese yen. So you can see here, this is the overnight move in the yen, and it's been a pretty phenomenal move actually. To see this kind of move in one session is fairly unusual. So when I come in and look at the charts, I think the first thing I said to Bill was, what's the yen news? What's happened overnight? That immediately jumps out to me that certainly something has changed, because I was looking at, being the news person that I am, I can't stop looking at the news. I'm pretty much on Twitter, I would say every half an hour, looking at what's going on. And I did see actually a report last night in the Nikkei news agency suggesting that the stimulus measures that might be forthcoming from the government when the BOJ announces the interest rate decision on Friday, that fiscal spending on the stimulus could be doubled. So obviously that's a more powerful fiscal measure, in combination with the fact that the market is pricing what analysts are around 80% sure of an interest rate cut as well from the BOJ on Friday. So when I came in, this was exactly not what I was expecting. If they're going to do a monster-sized dual package, then I'll be expecting this to go the opposite direction. The yen should be weakening. First thing then, I had a look, and this is the reason why. Finance Minister in Japan, Taro Aso, said the government has yet to decide on the size of fiscal spending package, and that monetary policy decisions are in the Bank of Japan's hands. That to me then, he's pretty much made an about turn from what some of the press are suggesting, saying it's up to the BOJ to take action, not the government. So the complete opposite. Now, if you remember what I always say, the market is all about pricing of expectations. The market is expecting something in the region of 20 to 30 trillion yen worth of stimulus to come from the government in various forms. And this latest comment from the finance minister overnight would say that that hasn't yet been decided. And hence this correction that we've seen with yen strength. And obviously when the yen strengthens, that has a negative effect on the local domestic stock market, the Nikkei 225, given the large proportion of export names. So that's the kind of yen story from overnight. But there are a couple of other key headlines that have come out. Firstly, let's take a quick look at some earnings. You've had the first of the big oil majors come out this morning. BP, I don't think it's really too much of a surprise. Their profit's down 45%. The market's become accustomed to these large, almost catastrophic drops in profit from the oil majors. Kind of comes ever since we saw that big push low at the end of last year and the beginning of this year. They're kind of blaming lower crude prices continue to erode income, and refining margins have shrunk. So their actual one-time items inventory changes dropped to 720 million profit. That was down from $1.3 billion a year earlier and missed analyst expectations of 819 million. So remember, at the end of the week, you have Chevron and ExxonMobil from the States. But BP, this will likely set the tone. Most people will be positioning for substantial drops in profit. But again, the actual reaction in the market has been fairly contained by the fact that this has been a reoccurring theme for a couple of quarters now. The other surprising news from an equity perspective overnight was Commerzbank. Now, for any of you that aren't familiar with the process, generally speaking, Commerzbank are, as far as I'm aware, weren't scheduled to announce their earnings. Not quite yet. However, what you often see, if there's bad information, or let's say a negative surprise in earnings, then banks sometimes front run their actual scheduled date. So in this case, Commerzbank last night, they've come out and warned that their capital position has weakened in the second quarter as a result of a number of accounting adjustments. So again, this was an unscheduled announcement. This is Germany's second largest bank by assets. And they've essentially said they've warned of a decline in their capital position. That's pretty worrying, given that it's Deutsche that people are worried about, but now you've got Commerzbank warning of decline in capital positions. Their shares opened around 4% lower this morning. I'm just seeing Monte Paschi shares this morning have been halted, limit down around 5%. So concerns on the banking system may gain a bit of traction. I've just flicked over here to the DAX. You can see already, as I'm speaking, coming under a bit of pressure. So Italian banks, it looks like, seeing some downside this morning. Commerzbank, slightly worrying to hear them commenting when Deutsche is seen as the more, let's say, valuable to their earnings report on Wednesday, could be very dangerous for the market if there is substantial losses at the bank. Next news story of note concerns the pound. So just share that with you. And particularly looking at the move when UK and European participants came in. You can see here we've had a shift from around 131.20 in cable all the way down to a low print at 130.93. So around a 30 pip move. That came at around 7 o'clock the selling commenced. Now this coincides with a report out of this chap who spoke in the FT last night. So the report being released early this morning, you can see here 5:30 a.m. You know, this kind of shows the way that news gets digested. If you look at 5:30 in cable, there wasn't really any move. It was only when UK and Europe came in you started to see a bit of pressure on the downside when that S1 level was also broken and the 131 handle as well. So the reason why this is important is only around a week ago, Martin Will was being very hawkish, arguably the most hawkish of the remaining MPC members. But he's made a swift turnaround, most likely because of that really shocking service PMI data we got out of the UK last week. And remember, that's critical for the UK economy because our economy is 70% or so geared towards the service sector rather than manufacturing. And if that's showing substantial weakness, that is a real concern. So Martin Will has indicated he's changed his mind after a series of negative business surveys. Remember that CBI number we had was a much weaker than expected yesterday. And he now favours an immediate stimulus for the UK economy. So for me, this is pretty much then a sign that we definitely are going to see action in August. The question mark now then is in what form, in what shape is the package in which they deliver. Is it simply an interest rate cut? Is it a cut and a hint towards QE forthcoming later this year? Or is it both immediately? And there are other various liquidity type measures they could take as well. But with Martin Will, arguably the most hawkish member, switching sides and becoming more dovish, then certainly I would say that pretty much seals the deal of August action is forthcoming from the BOE. So just keep an eye on cable. Certainly some downside forces today could well be prevalent. Now, just moving slightly off topic, something I just happened to be reading last night, and it's about Hillary Clinton. And the reason why I bring it up is because she's been coming under some severe pressure in the press of late, most recently because of, on the eve of the party's convention, 20,000 emails were made public by WikiLeaks showing supposedly neutral senior party officials tried to undermine Mr. Sanders' insurgent left-wing campaign by publicly portraying him as an atheist. So a lot of mudslinging going on at the moment, at Clinton in particular. And when you couple this with a lot of the terror events that have been happening at the moment, what we have seen is quite a substantial swing towards Trump. Now, I point this out because the article which I was reading last night was by a guy called Nate Silver. Now, Nate Silver runs a blog site called 538, which focuses on opinion poll analysis, politics and economics. But the guy's background is actually sports blogging in baseball. But he uses quite a statistical technique to look at aggregating polls and demographics. And one of the key things here is that, let me just find the correct part. He's known, this Mike Silver, he's best known for election forecasts, including the 2012 presidential election, in which he correctly predicted the vote winner of all 50 US states. He's run in the likes of the New York Times. He's won political independent awards. So the guy's got a little bit of credibility, is the point that I'm making. Now, the reason I bring this up is that via his kind of technique, which is called sabermetrics, which essentially is a balancing out of polls with comparative demographic data. And I saw this last night, and I thought, wow, this is getting seriously dangerous now for what the future might bring for this year. And as I say, you've got Clinton coming under pressure. a lot of, skeletons coming out of the closet about conversations she may have had via email in the past, some of the blackmailing that's been ongoing to help push her position, and then stoke that fire with terrorism has been rife most recently in Europe, in the likes of Germany and France, and the chance of winning, if it were to take place today, according to Nate Silver, is actually Trump, 53.8% to Clinton, 46.2%. Now, whether that would actually materialise is very questionable at this point. Obviously, this doesn't occur, this election, until November. But it's quite interesting here then to see, if you look here, this is June, July and August. This is only the last 2 months. And look how Clinton and Trump, we were at 81% to 18% only at the beginning of June. Throw in the EU referendum surprise result, which has shown people's kind of staunch standing on immigration issues, given the terrorist attacks in Nice, in Germany. This has continued to get ever closer all the way into July, where now, in fact, Trump has overtaken Clinton for the first time. I point this out because from a financial markets point of view, when you're talking about the Fed decision, which is Wednesday, and whether or not they might potentially be hawkish, I think that would probably be the right stance at this given point in time. I don't think they're expressly going to say too much, but they want to keep their options open. And effectively, if the Bank of England are going to ease in August, the BOJ are going to ease on Friday, and the ECB effectively might ease or tweak QE in September, then if you like, all the other global central banks are providing the stimulus that you need, and it might give the Fed the more ammunition, or at least the option of potentially raising rates. Maybe not September, maybe December. But if Trump starts to gain more traction towards November, then certainly I think a US rate hike becomes ever more difficult for the Fed, just because of the political uncertainty a Trump administration would bring to the financial markets. When looking at the breakdown, again, kind of the score, having followed the Brexit. When it comes to watching firm seats secured by either Democratic or Republican, you can see, no surprise, the likes of New Jersey is probably the most strongest. Connecticut towards leaning to Clinton, whereas Trump, Georgia, Nevada, Florida are seen more Trump heavy for a potential victory. You can break this down again by the 538 electoral colleges. The map kind of really shows the divide in America. Essentially, California and New York areas heavily Clinton, but everything in between is Trump, essentially. These are the key states, though. So tipping point chance is where, this is very forward-looking, of course, but much like, if you remember, Newcastle and Sunderland were key to the pound sell-off in the overnight when Brexit happened, because they were potentially, Newcastle was very much on the fence, was expected to remain. They did, but only by a very small margin. So this is why Florida is really key. Florida, Ohio, Pennsylvania and North Carolina are going to be highly contested, Florida in particular. And so if they start to fall in one direction or the other, then it really starts to swing the overall vote. And these are areas in which I would be closely monitoring in the run-up to November. So this is quite interesting just to have a look at. I'll pop it in the chat after we finish the briefing. But just thought I'd mention it because I think it's something to contemplate, just given the slight shift now, given the new norm of the terrorism that's been taking place, particularly in Western Europe, but also in the US. and then also some of the ongoing political difficulties Clinton is facing at the moment. And given the populist rising we've seen in the likes of Austria, France, and obviously the UK as well, having voted for Brexit. Okay, quick to finish things off, look at the calendar for today. This morning overall is fairly quiet actually, not too much on the agenda. This afternoon though, we do have the service PMI number coming out of the US. We also have new home sales and the API crude oil inventories, of course, after the NYMEX pit close. Looking at the PMI number for the US, we've been fairly consistent here actually. Unlike UK and Europe, where data's been quite volatile with, apart from IFO yesterday, which was surprisingly strong, there's been risks of downside surprises post-Brexit, but the US has been fairly robust on this measure, so I'll be looking for that to maintain a solid above 50 expansionary print today when that comes out. Probably not looking for a great reaction on the back of that. More so, again, I'll just be interested to see how the market takes on oil today, given the influence it had over prices yesterday. Overall, for equity players, many might be waiting for these guys to report. Apple, seen as a kind of big bellwether, not just for equities, but also for appetite in the global economy. They're one of the largest, if not the largest, company in the world. The key area, though, is they're expected to report the worst quarter for iPhone growth since the device was first launched 9 years ago. Analysts forecasting a drop in unit sales of as much as 20%. Now, this is really key. I think it's something like 2/3. Yeah, Apple's flagship product accounts for around 2/3 of its sales and an even greater portion of its profits. So things like iPad, iWatch, their sales have been decreasing for some time because they've been somewhat cannibalized by the fact that the iPhone Plus came out. Why would you have the need for an iPad? The iPhone Watch has been arguably a bit of a flop overall, very underwhelmingly met by consumer demand. So it all lies on the iPhone, and if you're to believe most recent press articles, they're going to delay the refreshing cycle of the iPhone potentially. So instead of bringing out a new iPhone and an iPhone S every year, they're talking more likely a 3-year cycle. And so whether that's going to also impede demand is yet to be seen when they're under constant pressure, particularly in the Far East in China, by more low-cost rivals. So it's going to be very interesting to see how Apple fares. Their demand side and sales out of Asia is really key as well. I was talking about this with a couple of the guys yesterday in the training room. Culturally, an iPhone in China is seen as a kind of a product, an expensive accessory, a sign of wealth. And if that's decreasing and there's lower demand for these products, then you could read somewhat between the lines of the health of consumer activity and purchasing power in China. They're going to be coming after market though, so you are going to have to wait for that. Their guidance will obviously be key, and it's the iPhone sales that are really going to be the one to watch out for. Just quickly wrapping up then, overall, again, the DAX under a bit of pressure as I've been speaking. Equities just been ebbing lower. Bund futures then elevated with a slight softness in equity markets. Again, the yen's been strengthening on the back of repricing that potentially we might not get the powerful stimulus we were expecting from the government on Friday. The Bank of Japan might act, but the question mark seems to be, will the market feel that that's enough? The way that the yen's moving, probably not. Again, it's been on the down foot. It's down nearly 2 points already, on the back foot I should say. So equities under pressure. Commerzbank worrying about their capital position and further charges. Italian banks under pressure again this morning, so equities down. Fixed income, bid, flight to quality leading gold to move to session highs as well as I speak. Data more backloaded to the second half. US focus, services PMI and housing data and the APIs to follow after market with Apple. Okay guys, enjoy your session and have a good one.